S&P 500, the Dow, VIX, TSX 60, MERs, Russell 2000, ETFs, RRSPs, TFSA, RIFs, RESP, ECT? That's just part of the alphabet soup of terms the financial service industry just seems to expect everybody to know. And I believe that we often miss the opportunity to empower investors. So in this video, we'll go back to basics and go through 13 basic investing in personal finance terminology that everybody should know. Before I continue, I just want to apologize on behalf of the whole industry. I want to say sorry if we ever had an interaction and I didn't have enough wisdom or confidence to speak plainly. I find that the more experience I get, the less I rely on jargon to show my expertise. And this whole channel is about changing that perception and that imbalance of language. So let's share this to help others.
Money does not possess me. Money? Or is it money? Somebody gonna have to tell the truth and I'm gonna tell it.
Hey, I'm Hervin Pesa. If we haven't met before, welcome. I'm a financial planner, but just like you, I'm on a journey to building wealth and financial independence. My mission is to help you build your wealth so that you can live a life full of meaning and one that's full of joy. I share weekly videos diving deep into money lessons we all wish we got from school. So if you're ready to get serious about money, join us in this journey by subscribing and be sure to hit the bell so you never miss an episode. Feel free to ask questions in the comment section below. I might even do a video response just like I've done in previous weeks for subscribers. What is investing? Investing is the act of committing a resource with the expectation of generating an outcome that is usually positive, some sort of return. Technically, any endeavor that commits a resource for the outcome is investing. It just depends on what return you're after. When you invest in a flashy car, you're probably investing in smiles per hour. If you're after Instagram likes, cars typically have a better ROI or return on investment than financial goals do. But if you want to get serious about building wealth, you need to create habits. You don't become an investor because of the dollar amount. You become one when you consciously defer gratification so that you can start building. It doesn't matter if you start with 50, 100, or 200 bucks. When you learn to pay yourself first and then you invest, you are an investor. So the sooner you start, the sooner you have compounding working for you. What is capital? Your capital or your principal or your initial investment is the amount of money that you are committing to the investing endeavor so that you can get a return. When you invest $1,000 for a year, you're committing that $1,000 in anticipation of the return. What is an investment return? Your return is the total amount your investment gives you beyond your capital or principal. If you invested $1,000 back in 2020 and got $1,100 today, your return was the $100 in excess. You had a 10% return. If you put away $1,000 today and get back $1,250 in 5 years, you have a total return of 25%. However, because you waited 5 years to get that, you have an average annual return of 5%. When creating financial plans, you must determine your required rate of return or the minimum returns you need to accomplish your financial goals. We don't live in percentages, we spend in dollars, so you need to tie back your investment returns or your performance to how it impacts your life now and in the future. What is compounding? Compounding or compound interest is simply when you reinvest your earnings or your profits from previous investments. Think about it as your money working hard to get more money for you. The longer you let your money work for you, the more awesome compounding is. Imagine somebody with nothing starting from scratch but has great discipline and they're able to save $1,000 a month. If they earned a 7% annual return, it would only take them 6 years and 7 months to get to $100,000. But it'd only take another 4 years and 11 months to double that to $200,000. From $200,000, it'd only take another 3 years and 5 months to get to $300,000. It's also known as the secret weapon for the younger investors because it allows a 25-year-old who invests consistently to multiply every dollar that they invest by up to 5 times, while a 55-year-old will grow their investments by only 1.4 times. You can watch the full video about compounding here so you can learn how that worked. What are unrealized gains and losses? With any market-based investment, you can see the value of your investment balance go up or down, so it's possible to receive statements or balance updates which show a higher or lower balance than last time you checked. It may be even lower than your total invested capital. However, what people tend to forget is that you can't pay with statements, so you still have to cash out of your positions in order to pay for things. Until you cash out, you have not realized or crystallized any gains or losses. You haven't made or lost any money yet. It's important to understand that in most cases, even if the account balance is down, you still hold the same number of assets, shares, what have you. Whether those fund units are going up or down, you still have the same number. Think about your home value. It might go up or down any given year based on the tax assessment, but does that change how you use the house? Of course not. What I'm trying to highlight is that unless you intend to sell or refinance at that point, the house assessment is irrelevant to you. What is risk? According to textbooks, risk is the probability that the outcome is something that's other than what we're expecting. However, that means little to you or your life, so let's redefine it. Risk to us is the potential that some event prevents you from reaching your financial goals. Risk is not simply about your portfolio balances going up or down or getting results that's less than what you want. I will have a separate video on financial risk and different types, but when you're looking at personal finance, you have to see risk as it impacts you. Go back to the home values changing example. Home values changing based on the tax assessment does not impact you unless you're selling. The overall stock market could be down 5% today, but it has little impact to you if you're not retiring within the next 5 years. What is volatility? Volatility is the financial stand-in or the mathematical stand-in for risk. It's usually stated in variance or standard deviation, and the formula for both are equally ugly. So let me give you a visual instead, and let's explain what it's really trying to measure. Imagine that I'm playing darts against a professional dart player. Yeah, me, Mr. Semi-Coordinated. We both have the same target, which is the bullseye, and we both get 10 tries. Between the two of us, it's very likely that he will land his dots in a smaller perimeter around the target. If we were given 10 more tries, it's gonna be easier for us to predict where his shots are gonna land because it's in a tighter band. Volatility uses the average as the bullseye. How far away the shots deviate or the returns deviate from the target allows us to compare between multiple investments. The wider the range, the more volatile. So what does this mean for you, and what does this have to do with risk? Remember that in finance, risk is about predictability of outcomes. The wider the range, the more uncertainty, therefore the higher the risk. Let's say that we have two investment choices, Fund Ate and Fund Kuya. They both have the same average return of 8%. However, Kuya has a standard deviation of 2%, while Ate has a standard deviation of 6%. We can expect both of them to get an 8% return again next year. However, there's a 68% chance that Kuya's return will land between 6% and 10%, while there's the same probability that Ate's return will land between 2 and 14%. Mas volatile kasi talaga si Ate. On the other hand, you may think that a guaranteed rate of 2% is safe because there's no volatility. Your investments are always getting the same 2%. But you could be at a higher risk of missing your goal if your retirement plans and contributions have a required rate of return of 5%. What you'll end up doing is you're removing volatility, but you're guaranteeing the failure to meet your financial goal, which is actually a much higher risk. What is a portfolio? A portfolio is just fancy speak for the grouping or the total of all your investments. Just like an artist would have a portfolio for all of her work, and an investor should have a portfolio, a collection of all their holdings. However, what sets savvy investors apart from novices is savvy investors create portfolios with purpose. They don't just hold random assets and random picks based on what their barbers and their Instagram models tells them. According to Harry Markowitz's modern portfolio portfolio theory, an investor should create a portfolio that allows them to hit their required rate of return at the lowest risk possible. Remember Fund Ate and Kuya? There's a chance that Ate could get a 14% return while Kuya didn't have that based on the same data set. If your required rate of return is 6.5%, both funds could potentially hit that. But why would you need to expose yourself to the possibility that you'd get a 2% return if you picked Ate? What is asset allocation? Asset allocation is the thoughtful creation of a portfolio that meets financial goals by using different asset classes in a way that reduces volatility but still meets the required return. You might have heard of a balanced allocation before, or a 60-40. This typically refers to the percentage breakdown of each asset class as it's determined by the strategic goals of each investor. What is an asset class? Asset classes are simply common groupings of assets that behave similarly enough to each other. With real estate, condos are compared and grouped against other condos. With cars, sedans are compared with other sedans. Different vehicle types have different purposes and have different performance. It's the same with financial instruments. The most common asset classes are equities or stock, fixed income or debt-based instruments, cash or cash equivalents. However, each class can be subdivided based on size, geography, and maturity dates. For example, you can have American equities and international equities that are grouped differently. Both are stock-based classes, however, they would perform differently enough that they can be subdivided. What is a stock? When companies raise capital, they could sell off a small portion of their ownership and share that ownership with you, the investor. When you buy stocks or equities, you are buying ownership into the company. When you invest in TSLA or FB, you are becoming partial owners of those companies. However, when you buy the market, you become partial owner to hundreds of different companies. What is a bond? A bond is an IOU. When you buy bonds from a company or government, you're effectively lending them money. This financial instrument gives the investor fixed interest payments throughout the term of the bond, and then they would get their capital back at the end. This is why it's categorized in the fixed income class, because it gives fixed interest payments throughout the term. What is diversification? Diversification is having multiple investments within an asset class. Let's say you have $100,000 to invest, and your long-term strategic allocation calls for a 50-40-10 split. 50% in equities, 40% in fixed income, and 10% in cash. You can divide the 50% or 50 grand into 5 different companies, or 50 or 500, depending if you invest in a mutual fund or an index. What you're doing is essentially making sure that your $50,000 egg is not in the same basket. Some of those companies might go under while some shoot to the moon. Rocket ship, baby! Diversification is simple, really, when you think about it. However, it is difficult to implement for individual investors, even pros, because it's an exercise in humility. By diversifying, you're saying that you're not smart enough to know exactly what the future holds. Same here. That's it, 13 different terms that you may have been too shy to get explained to you. Because we want to focus on investor empowerment, we'll be increasing frequency with shorter videos in coming weeks, sharing more terms so that you can have quicker bite-sized educational content. Be sure to subscribe and hit the bell so you don't miss any of those. If there's a specific topic you want us to cover, let me know in the comments. Until next time, stay aware, take control. I love y'all. Peace out. Don't forget to share this. Bye. Watch this next video. That video. This.